Can you guys all hear me? Oh, wow, it's very loud. Cool. Cool. Thank you so much for being here. Good morning. I think it's still the morning. My name is Saira Rahman, and I'm going to be chatting about how neobanks make money. I'm also prepared to disappoint you all because I think the first thing I should probably start out saying is that neobanks light money on fire, to those of you that don't know. Quick background on myself. I'm currently the VP of Finance at H.M. Bradley, which is a neobank. Your local neobank is what I like to tell everyone. I also happen to be the co-host of a small podcast called Girls Just Want to Have Funds. A little bit of background on myself on that slide. Feel free to reach out if you have questions after the presentation. Things that I'm going to be covering today. First and foremost, exactly how banks differ from neobanks. So I think one of the things that people tend to get confused about is that a lot of neobanks compare themselves to banks. They say that they're improved versions of banks, but really our revenue streams differ. The second thing that I want to talk about is all the different revenue models that exist across the industry. So there are lots of different neobanks that do different things and target different customers, and we've really built ourselves a unique model in terms of just not only H.M. Bradley, but also all the different neobanks that exist today. At the very end, I'll be taking questions, so please hold back all of your excitement until that time. A couple things that I won't be talking about. First and foremost, some of the neobanks that have converted to charters, I think that they have a completely different revenue model now, which I'll touch on lightly, but I won't dive in too deeply on. And then I think those of you that know me know that I tend to have lots of corny jokes, so I'm going to try to hold as many back as I can. So I wanted to start the conversation by asking you guys, how do you think banks make money? Feel free to call it out if anyone knows. Nobody knows. Interest. That is usually the most common answer, and that is actually exactly what I was hoping to hear. So banks, in one method of an income stream, make something called net interest margin. And what they do is they bring borrowers in the door, or customers in the door, and when those customers come in the door, they say, here, take my money, and they expect something back called an APY. And that APY is the interest that you receive back on your money being deposited at Bank of America, Wells Fargo, whatever bank you want to deposit your money at. And in exchange for that, the bank then takes that money and puts it back out into the market by lending or investing at a higher interest rate. And that difference between where the bank is lending or investing and where the customer comes in and gets to put their deposits in the bank, that difference between those two rates ends up being the net interest margin. And that tends to be the concept that a lot of people contemplate when they think about how banks make money. And one of the things I really want to differentiate is that those two bases of customers, the customers that come in the door and provide dollars, aren't necessarily the same customers as who they are lending to and where they're ending up investing into. So that's the first way that banks tend to make money. However, if you take a look at where interest rates have been over the course of the last 30 plus years, I use the 30-year mortgage as an example, but realistically, we can talk about any interest rate within the market. So that's LIBOR, that's Fed funds, that's prime. They've declined precipitously. So how does that affect the net interest margin? Well, I don't know if you guys have noticed, but APYs are at or near zero, unless you're H.M. Bradley. And the lending and investing rates have also gone down drastically. And that's because most borrowers are asking for substantially lower interest rates when they're going out and getting their loans. So what happens to that net interest margin? It starts to shrink. So the economy that we're currently in for banks is one where their net interest margin is completely compressed. So they have to find alternative sources of income, and they tend to look into non-interest income. This is also known as fee income, and it's something that every single bank does. And you'll notice that a lot of these are products that exist in fintech land. But what I did was I took a look at what all of the major banks profit from in terms of non-interest income, and I ordered them generally based on the highest fee generator all the way down to the lowest. So you'll notice at the top is wealth management. Just after that is mortgage banking. That's something that's really become prevalent over the course of the last 18 months. I don't know if anyone else has tried to buy a house over the course of the last year, but it's currently a nightmare, and that's because of some of the things going on in the mortgage industry. Deposit-related fees is a polite way for a bank to talk about how they charge people for their deposit accounts. That's overdrafts and NSFs. That's wires, that's ACHs, that's all the fees that come out of your deposit account. Next up is card fees, and that's generally including interchange. Excuse me. So for those of you that aren't familiar with interchange, every time your card gets swiped, there's a small, tiny little percentage that goes to interchange, and that interchange is profit that goes to the bank for each of those credit card or debit card swipes. Thereafter that is commercial lending related fees. Something that I think people understand is commercial lending does provide interest, so that net interest margin does come off of commercial lending. But one of the biggest fee generators at a bank is actually the fees attached to commercial lending, which means when a commercial loan is created, there's also origination fees. But from the things that I've experienced personally as well is they also generate treasury management fees, account management fees. They get referrals into wealth management. They get referrals into different segments of the bank that end up being cross referrals and additional fees that get tacked on to that commercial loan. Then comes brokerages. I'm sure everyone's familiar with what that looks like. So if you have a Bank of America account, you can open a Merrill Edge account. And then I personally love putting investment banking on here to show everyone that despite the fact that we pay investment bankers quite a bit of money, investment banking tends to be the lowest, if not one of the lowest, fee income generators for banks across the country. So next question. We know that neobanks need to rent a charter. So they partner with sponsor banks in order to be able to have access to in order to be able to provide banking services to their customers. Does anyone know why a sponsor bank would want to partner with a neobank? So the number one reason why a bank would partner with a neobank is because they generate additional fee income. So that non-interest income it goes straight to the bottom line for them. So the reason that we've seen such a massive increase in sponsor banks is because they want to gain more of that non-interest income. So we essentially, as a fintech company, pay for that charter, and it goes directly to their non-interest income, which is why we've seen such a massive resurgence. So I listed a whole bunch of different neobanks here. I kind of just thought about them top of mind. So on the one side, we have the chartered. So SoFi recently purchased a bank, which is how they've become a chartered bank, and their financials will change drastically over time. Varo, I'm not actually going to touch on because I love their model, but they're not doing a great job of setting the example for the rest of us. However, in terms of the rent-a-charter, there are both business banks and neobanks, and there are many, many more than what I listed here. But these are generally the ones that were top of mind for me to give you guys an idea of what the ecosystem looks like, both here in the US, and Revolut also happens to be international. So does anyone know how neobanks make money? Interchange, yeah, for sure, and fees. So I created a little chart, and it's like a target. And the center is where most neobanks tend to focus their income. And the further out you go, the less likely you are as a neobank to be utilizing that product. So just like several of you mentioned, Interchange is the primary product for the vast majority of neobanks. What Interchange does is provide a consistent amount of income depending on how many swipes your average customer gets. So if I am your debit card customer for a neobank, you are keeping your fingers crossed that I'm going to Target at 9 p.m. on a Friday and I'm buying 8 of those pillows and I'm swiping your card and I am what's called top of wallet, which means your card is the primary card being utilized by that consumer. Same thing goes for a business bank if they have a card as well. The next rung out, fees. I think fees get a little bit of a bad rap because of what happens at traditional banks. However, every single neobank also charges fees. I know that we kind of have this thought, I guess is the best way to put it, that a lot of neobanks don't utilize fee structures, but I can't think of a single neobank that doesn't make some percentage of their overall income from some form of fee income. The next rung out is interest. So every single neobank that has a trade line, so whether it's a credit card or whether it's a consumer loan or a business loan, they're generating interest from anyone that's carrying a balance within their product lines. And then we get to stuff that's a little bit more non-traditional, so subscriptions. Subscriptions are interesting because only a handful of neobanks tend to use it, and essentially what they've done is they've created a method of being able to force you to pay additional fees on a monthly basis in order to gain access to certain product features. And those product features can be anything from getting a 2-day early paycheck to having certain lower fees when you do cross-currency transactions. The last rung on here is somewhat of an interesting one because I personally would probably lump it in with fees, but what we do in fintech and what we do at Neobanks is we have an excellent method of rebranding everything in the industry, and we've rebranded fees into tipping and donations. And the unique thing about tipping and donations is that when we relabel them, we make it either A, optional, and B, we give the consumer a way to choose exactly what those fees are. And by putting that back on the consumer, a lot of the neobanks have been rapidly successful in getting a significant amount of fee income without forcing their consumer to pay for that fee. So I know everybody's thinking in the back of their head, or maybe you're not because you assume that we all have the same exact structure, how H.M. Bradley differs from other neobanks. So in order for me to explain it correctly, I have to provide you guys with a little bit more detail. So we talked about the income statement, right? So we talked about all of the ways that neobanks make money, but we haven't really touched on exactly how H.M. Bradley makes money. And what you'll notice is there, on a balance sheet, there's assets and liabilities. And the biggest line item at any bank, so including a sponsor bank, is NMDs, also known as non-maturing deposits. And those non-maturing deposits are typically the largest liability, and those are every single borrower, or customer, sorry, that comes in and says, I would like to put my money here. They are generating non-maturing deposits for the bank. And what H.M. Bradley does is we take a look at both sides of the balance sheet, and we simultaneously assist on the loan side. So remember that first slide that I was talking about where we generate net interest margin. So customers walk in the door, they provide them with deposits, the bank then pays back an APY, so they're delivering out an interest rate. Simultaneously, at H.M. Bradley, we're assisting on the loan side by providing everyone with the ability, or by providing commercial lending and lending generally across the board in order to alleviate some of the cost of all the expensive deposits that come in the door. So that was my whole presentation. I kind of blew through it, but I'm happy to take questions from anyone that has any. Please. What's the difference? So cash is, sorry, I'm going to go back to it. So cash is an asset. So when you're collecting cash, that is an actual asset side, and non-maturing deposits are coming in the door as an actual liability. So I'm paying someone for those deposits, whereas the cash is actually sitting and I don't have to pay for them. So that's coming from the profit that I'm making off of my products. So the non-maturing deposits are deposits that are walking in the door. So that is you going to ABC Bank and saying, I'd like to put my paycheck here.
So is cash just a combination of fees and like current interest?
So the question was, is cash a combination of fees and current interest? And that's correct. So that is typically how some of it gets reported. Sure. Yeah, so I think that would go underneath the fees. That would just be part of, sorry, I'm trying to go back to that correct slide. But I think that would generally go under fees.
Sorry, I think I heard something about in the cards, so say credit cards. Is credit I mean, obviously, there's a big piece of the revenue, of the card network revenue that an issuing bank can have. But what's causing, is that, you know, first question, is there a increase in card as a line of business for neobanks? And is there some other, what are the reasons for that?
What are the reasons for cards at neobanks?
What are the reasons for, is card growing as a line of business?
Yeah, absolutely. I think that cards are the biggest space for neobanks because both on the debit side and on the credit card side, I mean, on the credit card side, you actually have more income streams than you do on the deposit side. So with, for example, at HM Bradley, with our deposit product, we provide the APY to our consumers, and then simultaneously we only charge them very specific fees. But when it comes to our credit card, we not only get the interchange, but we also get interest from anyone that carries a balance, and we simultaneously get an annual card fee from anyone that has our card for longer than a year.
So it'd be fair, you know, I work with TransUnions, it'd be fair when I'm talking to our you know, market developers in the card space to expect a lot of continued growth in the card line of business coming from the neobank space.
Absolutely. I think most neobanks target growth within the card space. Yeah. Please.
Hi. What is your new customer acquisition go-to-market strategy? And how are you finding your customer acquisition costs? I know you probably can't know what it is, but how would it compare to like traditional banks, or what's your feeling about that, especially as compared to customer lifetime value?
Yeah, absolutely. So the question is, what is our customer acquisition strategy? What do those costs look like as it compares to a traditional bank? So twofold for us. I think our APY being significantly above market has provided us the benefit of a lot of people walking in the door. So we haven't really struggled. It's been mostly organic for us from a growth perspective. In terms of growth channels, I think we use pretty standard ones when we have used them historically. However, I'm not sure how many people in the room are up to speed on HM Bradley as a product, but we, for better or worse, had to gate our product, and we are only on referral at the moment, but we are still growing at essentially the same speed that we were growing at prior to gating our signups and being referral only. So from an acquisition standpoint, I really like it because our growth team currently has a $0 budget. Yeah, VP of Finance guys, sorry. I'm always thinking about the budget. But as it compares to traditional banks, I mean, banks tend to have extremely high customer acquisition costs in my experience, and I think that's one of the benefits of being a neobank. We're nimble, we're small, and our teams are very, very focused and efficient. Yeah, so I mean, when we have used growth channels, we've done targeted advertising via social media. Please.
I'm curious your opinion on the challenges that these sponsor banks face when a very successful neobank comes along, wants to partner and throw tons of cash to that bank.
I've never experienced that before. So the question is, what happens when a neobank becomes extremely successful and a sponsor bank starts to face some struggles on the growth side, which may or may not be our exact situation at the moment. So curious with the sponsor bank, sorry.
So I'm from Oklahoma. I know some friends at Stripe Bank in China. Is there
Sure.
neobanks? So I'm just curious.
Yeah, I think it's difficult because there's a lot of, going back to the balance sheet, there's lots of liquidity requirements when you're growing your deposits rapidly. So I did a short stint at a community bank. I have a general idea of exactly how financials work in traditional banking as well. And the banks have to put up a bunch of cash in order to be able to prove that they can support their customer base. So when you grow extremely rapidly, you have to provide something called regulatory capital in order to cover the costs of that rapidly growing deposit base. And sometimes banks don't want to do that. So you have to kind of anticipate, or at least attempt to anticipate, the pace at which your neobanks are going to grow. For better or worse, we hit our projection in May that was supposed to be hit in December, and our bank turned to us and they were essentially like, we need to slow down a little bit. So that was why we ended up getting our referrals. But precisely the problem that I'm sure lots of other neobanks face as well. I was just having lunch with someone yesterday who was sharing the exact same sentiment. It's just difficult. It's difficult to figure out exactly how much your deposits are going to grow with such a rapidly growing space. Please.
So it's obviously a very growing space. What are the main differentiators between neobanks as they compete with one another? Because it seems like they have a lot of the same offerings and benefits to their users.
Yeah, so the question is, what are the differentiators between all of the separate neobanks? So I think the cool part about neobanks is that they try to target different niches and they specialize in certain products. So Chime has a very unique customer that they do an excellent job of targeting and acquiring. I think there is a slightly different customer that Current targets that offers a subscription model as well to offer different benefits. I will tell you that at HM Bradley, we target an entirely different customer. Most of neobanking hasn't historically attempted to target savers, which is what HM Bradley does. To those of you guys that don't know, we essentially reward savers that provide their direct deposit to us with a higher APY, depending upon how much of their APY is saved. So I think different neobanks have different targets. It's a little bit harder to see when you're outside. But like for me, when I'm knee deep in neobank land, each one has really interesting targets, and the differentiators are very nuanced because essentially we can all provide the same products, right? Like if HM Bradley wanted to, we could do the 2-day early deposit. It just doesn't fit our consumer. Please.
Do you do mortgages or commercial lending? And when you have excess capital, do you sell that capital, or do you loan it out to other banks that may use it for other types of loans?
So the question is, do we have commercial lending or mortgages, and do we sell it off, or what was the rest of your question?
And then so if you have excess capital, do you then lend that out to other banks that may need more deposits?
Yeah, so in terms of strategy at our entity specifically, it's bifurcated. So I essentially view myself as, I'll call it like a lender to our sponsor bank, and I will turn to them and provide them with the same exact things that a lender would provide to their CFO in terms of requesting a loan to go out, whether it's a portfolio of loans or whether it's an individual loan. And then they'll either choose to put that on the balance sheet or they'll originate it and sell it off. But because it's the bank's balance sheet, I don't have as much control in terms of what they do on the loan side. I can provide them with recommendations, but it's never, ultimately I don't have full control like a normal bank would.
So are you the ones actually, so if I'm trying to get a mortgage from HM Bradley, do I apply through HM Bradley, or am I going through the sponsor bank?
I love hearing that question. So it's, if I'm applying for a mortgage, do I go through HM Bradley or is it through the sponsor bank? So my boss might kill me for saying this, but I am confidentially working on a mortgage product as we speak. And it's going to be through HM Bradley, but you'd be originating onto our sponsor bank's balance sheet, which is not unlike other neobanks. Please.
So I still don't understand why don't or why won't a bank like Wells Fargo look at what you're doing and say, oh, we can do that too?
Yeah, so it's a very common question. So the question is, why wouldn't a bank like Wells Fargo do what you're doing and say, I can do that too? Honestly, I don't know. I look at big banks and I'm like, why don't you guys reward people that have direct deposits? Why haven't they tried it, right? Why aren't you trying to acquire more direct depositors? Why aren't they trying to do the 2-day early paycheck? I think recently we just started to see some traditional banks finally roll out the 2-day early paycheck. Chime's been doing it for a while. There's, just like I've seen historically, I think banks tend to be on this massive delay. They need to see everyone else doing it first and then they'll contemplate it. But I think the other piece of it, especially with our specific product, is banks are flush with cash right now. We're in a market where money is walking in the door and nobody's asking for APY. Unless they're intentionally seeking APY, they're not looking for products like what we have. So it's bifurcated. I think it's there's always a lag in traditional finance to do the same things that fintechs are doing. And then I think the second piece of it is they don't necessarily need to yet. And I think by the time they're ready to do what banks like HMB are doing, I highly doubt they're going to be able to acquire the customer in the same way that we have. Sam.
That's a good question.
Yeah, look up Wells Greenhouse, Chase Bin. Try to build this on a legacy stack. Good luck. So on the slide, we showed all the neobanks. You basically stuck with the U.S. You did have Revolut on there.
Yes.
So politely, why do you think like a Monzo and N26, when they tried to come into the U.S., it didn't necessarily go that great?
Sam, I have such a hard time being polite.
Is there all friends and no one's going to tweet?
Yeah, no one's going to tweet anything. So the question was, why do international banks have such a hard time entering the U.S.? Regulation, right? Like Revolut made the attempt, and you know, they're sort of here. I think that the regulations and the way that everything's built in Europe and the EU generally the laws there are so much more beneficial for fintech companies. You just see so much more innovation. You see so many cool companies coming out over there. Whereas here, you apply for a fintech charter, and $15 million later, you're like, okay, well, that didn't work. So, you know, until the U.S. loosens up a little bit and the FDIC figures out exactly what fintech means, I think we're going to struggle as an industry. Please.
Thinking back to your slide with the balance sheet, we zoom in on the loans part. Can you talk a little bit more about the type of loans you're making, the time to maturity on these loans?
Yeah.
Confidential, maybe the
So some of the stuff is confidential, but to give you an idea, so the way that banks view balance sheets, non-maturing deposits, you have to make big, vast assumptions about when you think people are going to walk out with that money, right? So the industry assumption is about 5 years on non-maturing deposits. So that's the duration that you assume of your largest liability. And then you have to assume duration on your loans. And on the loan side, banks want extremely high yield for as short a period of time as possible. So most of them are targeting a sub 5-year duration on the loan side. Questionable how many of them are actually hitting that. I used to help a lot on the balance sheet hedging in a prior life, and I can tell you that like duration estimates are just like fingers in the air. So when I'm attempting to originate, I try to go as short on the duration as possible because it's really not my balance sheet. So I'm doing similar things that I would do if I was a CFO, in terms of trying to build out a duration where the assets are as close to matching the liabilities as possible, because you want those to mature at a similar time.
You talk about being like top of wallet, right?
Yes.
From like a debit card standpoint, how do you compete against credit cards who offer points?
Yeah, so I'm just going to repeat that question back to you to make sure I heard it. So you're saying, how do debit cards compete against credit cards?
Yeah, I mean, like, is it just people who don't have credit cards that are using debit cards, or can you actually like utilize, can you get people to use their debit cards more over credit cards?
Absolutely. So I will tell you that in my experience, debit cards are one type of customer and credit card users are a different type of customer. I know a lot of people have been told historically that credit cards are bad for you and all of the things. However, as a neobank, in terms of interchange, you make a lot more money in interchange on a credit card than you do on a debit card. And generally speaking, at HMB at least, our customer base is not typically a debit card user. So our customers tend to use their credit card more than they use their debit card. But it varies from neobank to neobank. And to be quite honest, I don't know that they compete with each other. I think people utilize the debit card for different reasons than the credit card.
I'm hearing rumors that interchange could be under pressure here in the U.S. Compared to like Europe, it's much higher here. Fees are charged at interchange. Just curious your thoughts about if you think it is going to change, because that really strikes at the heart of the model for a lot of neobanks. If like Congress say doesn't want Durbin Amendment or other things to put downward pressure on interchange.
Yeah, so my opinions on interchange. So at HMB, we're a little bit agnostic to Durbin. So he's talking about an amendment that was made to Dodd-Frank that has to do with banks that are over $10 billion. And To be perfectly frank, I don't know. I mean, you're talking about like something between 1% and 3% on the high end in terms of the income that comes off of interchange. And while it's absolutely imperative to most neobanks in terms of how we make money, I also think that there are lots of other income streams, and it's just a matter of how we want to lever ourselves in terms of figuring out what those income streams are. But beyond that, I honestly don't really know, because I would be curious to see how much they want to reduce that interchange by, because I personally have not modeled out what it would look like if we lost a bunch of our interchange. Cool. Well, I think we can wrap it a couple minutes early then. Thank you so much for coming, everyone.